Judges, we have here our first contestant today, Pittsburg State. Take it away.
All right. Hi, everyone. I'm Carson Cowan. This is Sam Coleman. That's Nate Parrish, and this is Johnny Harris. So the argument is specifically that should the government take preventative action to ensure deposits of Silicon Valley Bank over $250,000, as it has since gone insolvent, essentially. The argument can go either ways. One is, for example, that the government should bail them out. A lot of money is held within Silicon Valley Bank, and the Fed specifically asked a few years ago when they put all this money in the system to buy long-term bonds. Well, the issue is the interest rate today is higher than long-term bonds. So if the bonds that the banks hold are sold today, they will incur a loss upon that compared to what they would later on. And so banks are trying to figure out what to do. There's a lot of issues in terms of their liquidity management, how they are able to pay anything in the short term. So essentially, since a lot of money is held within there and the government told banks to do that, you could say that the government should bail them out because the government asked them to do this specific action for the time being, and as a result of interest rates increasing due to the Fed's current initiatives, then the banks are suffering out of essentially a non-will choice in some ways.
So that's kind of our devil's advocate, kind of what our thought process is for the other point of view and where we can see what people are saying. But so the thought process that we've come up with is when you bail out these banks for taking risky investments with shareholder or stakeholder money, it creates a bit of a moral hazard problem where you have these banks can be very risky and they can play with fire all they want if they know that the government's going to bail them out, and there's really no incentive to be safe and to hold on to their money and do smart investments, because they would rather go for broke and then fail, get bailed out, and then try again versus playing it safe and then dwindling behind. So the thought process that we've come up with is, keeping the rules the same and making sure that the moral hazard isn't kept, and making sure that it's important that these rules have been set in place. It's been stated before. No one was under any impression $250,000 was exactly how much each person that put money into this bank. That's how much, or the depositor, how much money they would get back. That's what the rules said beforehand, and that's what should be done. And if someone has more money than that, unfortunately, then that's kind of what goes with the business of investing, or not investing, but depositing more money into these banks in the first place. And so it's really important that the government sticks to this precedent to make sure that it's even across the board. Because while you could bail out these big banks, what about the smaller banks that have liquidity problems? And what about these smaller banks, the local banks that go under? Do they get big bailouts, or is it just the large Silicon Valley Bank because it has large billion-dollar investments and billion-dollar depositors in it? Is it just them? And so that's kind of been our thought process towards this, of maybe making it even across the board, how the rule is $250,000 is the limit.
And an argument back for why the government should bail it out is that Silicon Valley Bank has billions of dollars in assets. It represents a good proportion of money on the West Coast, and it's a significant bank in terms of the economy. In the times that we are in, there's real concern about the economic future of the country. A banking crisis would only contribute to that. It'd make people, or make citizens, cut back on consumer spending and watch where they put their money at. That could contribute maybe to a slight bank run, although there are laws protecting it. Therefore, that would be an action towards it. But as
stated, so back in 2008, banks, of course, went under, and a lot had liquidity problems, and of course there was a lot of problems then. Then they got bailed out, and then there was still a recession, and then things were smooth for a little bit, and then the same problem happened again. And so it kind of sets the precedent of, if you bail them out, do they learn from the mistake in the first place? And does it end up actually helping that much in the beginning, when the banks should have maybe have dealt with their own failures and suffered their own consequences for their own actions?
So after all of this deliberation, we decided that the current policy should be to follow the FDIC insurance and give out $250,000 per account holder. If we do not do this, then it would create a precedent of being able to be bailed out and continue to try their luck again continuing to take risky investments and possibly hurting the economy even more by just continuing to crash.
And one thing we've kind of thought as well is if it's a problem that these banks that have, if it's a problem that $250,000 isn't enough, then the rule needs to be changed to allow that to be increased. If it needs to be $500,000, $1 million, doesn't matter. Whatever it needs, the rule needs to be changed for that in the first place.
To Sam's point, the FDIC current allotted amount for deposits per account was set back during the 1930s after the Great Depression and the banking crisis. That money hasn't changed, but the value of money, as all can see today, has changed drastically. $250,000 goes a lot less today than it does back then. So the rule would have to change for you to insure any amount above that, because it would represent a cumulative of what the country believes, because such action would have to be done through Congress to complete that, instead of having it being relied upon some sort of government agency such as the executive branch or through some affiliated organization like the Fed.
All right, I think that's all we have.
And that's all we have.
Any questions?
Would you be in favor of the government having different deposit insured amount for individuals as opposed to companies?
So as long as the rule states that and it's the same, as long as there's no special case per case by basis, if the rule is said in the very beginning before a recession, then personally I would be okay with that. I think you had a question?
Yeah, I think some of the worry was that, for your devil's advocate case, right, was that this would cause a run on similarly sized banks.
Yeah.
And so it would drive a lot of the small and medium-sized banks in the country out of business, right?
Mm-hmm.
So one of the things I'm wondering is when you're making your analysis, it seems like you're saying that the government needs to follow its own rule, and if we want the rule changed, we have to follow a process to change the rules. We have rules about changing rules, right?
Exactly.
So is your answer here, is it saying we ought to do this because it's the rule, or is your answer we ought to do this because I actually think it'll be the best for the country? So is your reasoning like consequentialist or like deontological here, if that makes sense?
So Carson, do you have anything you want to say about this?
I would say that our point of view is that the government needs to go by its own rules. It's okay for the government to take sometimes some action on its own, make decisions on its own, but when we're talking about a bank that holds that much money and stuff, having just a group make that decision isn't representative of how many people are, for example, within that bank. I mean, it represents a ton of people, it represents companies and things like that, so it doesn't represent a whole basis. And as we know, within the government system, there's a lot of lobbying activities. There could be some reasoning for that as why the group made that decision, because I know that Meghan Markle and Prince Harry have money within the Silicon Valley Bank. So there's a lot of pull there in the publicity that could attach to it. So there's a lot of reasons why maybe the moral or the government should be able to make its own decision with that. But rules are there for a place, and if you make your own decisions over time, sometimes you're going to have a lapse while the law will stay consistent in terms of making that decision.
I agree with Carson on this because the law is set, I guess, not necessarily set in stone, but it's consistent and it works for the same for everyone, right? And so maybe necessarily the law can change depending on what needs to happen, and when that happens, it can kind of accommodate the different aspects and say to prevent bank runs, then maybe new rules need to be put in place to prevent this. And if that's the case, then they need to be put in beforehand, so everyone can follow these same rules and it's not just special permission for certain large stakeholders.
And to his point, like with law and how the judicial system's run, you can always go against the precedent set, but doing so is going to be controversy. If the government gets into this action, continue to bail out banks, and it decides to go against that action of the past, it will contribute a significant downward scope in terms of the economy. It will put a shadow on the economy and how the government is run, for that example.
Yes.
From a Hayekian perspective, is the $250,000 cap, is it law or is it an arbitrary piece of legislation?
So I guess It is a little arbitrary why that number, I guess, is chosen in the first place.
I mean, the whole fact
Yeah.
that it exists, does this stem from the rule of law or does it stem from a piece of legislation, the rule of man?
I guess it's a difficult question to answer because I guess while on one hand it is just a rule given and put in place by, you know, people that have done this, I guess a rule of man, it's still a consistent rule and law that's given and followed, if that makes any sense. And it's the current, the rules of the game, I guess, if that makes any sense.